Hi, everybody. I'm Mansoor Ahmad from Victoreus LLC. I'm Chief Executive Officer and the only tax advisor of the corporation. Here to welcome you to a tax strategies bit that we're doing with my CTO, Miles Millen. Miles, can you introduce yourself?
Yeah, hi. How's it going?
Great. Miles is my Chief Technology Officer. He heads our IT services and consulting division. So Miles is going to sit with me while I go over like what is the best tax entity to choose if you're starting a new business. Like where are you going to get the most tax shield? What works best for you? In order for me to do that, I'm going to have to share my screen, and we're going to have to open something that I use whenever I work with clients who want a consultation. And keep in mind, all our consultations are free. So before I start, let me get it open. One moment. Let me get it open. I have something that I use. And then let me share my screen now. Okay, so this looks kind of complicated, right? Basically what I have here is a template I use for new clients who are trying to think of like what type of tax entity should they set up legally for their business. Over here, we have all the information for partnerships, limited liability or limited liability partnerships. We have all the information over here in Exhibit 2 for C corporations. We have all the information here in Exhibit 3 for S corporations. And then for those businesses that don't qualify for a deduction called qualified business deduction, this is S corporation without that deduction. So basically, like if you have an S corporation or a sole proprietorship, you get to be qualified for what's called a qualified business income deduction. So if I go over here, what that basically means is if you're not like a service industry, like you're not a CPA firm, you're not an attorney, you're just like any type of normal business where it doesn't require skill for your employees to serve people or run the business, you get what's called qualified business deduction of 20%, which reduces your revenue and arrives at your taxable income. So first what we do for that deduction is we take your expenses against your revenue, and then whatever's left over, we apply the deduction to at the rate of 20%. Now, if you are a CPA firm, or you are an attorney, or some sort of service-related business, you still may get the qualified business deduction, but if I recall correctly, the maximum revenue that you can earn is about $150,000 or more before like it phases out. So why would we choose S corporation so that we can have this deduction, or sole proprietorship? Sole proprietorship is like if there's no partners, you don't want to run an entity, you don't want to set up anything, it has the lowest setup costs. You still get this deduction called the qualified business income deduction, but the thing is, like, if someone sues your company, they can take you all the way to your personal assets. If you do a C corporation or S corporation or limited liability corporation, you're actually shielded because you can only get sued for the extent of your investment into the company, which is why people set up S corporations or C corporations. With C corporations, if you look here, let me move over to it, you don't get a qualified business income deduction. That is because C corporations have an entity level tax. You can see I put 0% for the qualified business income deduction. Now, why would we do a C corporation if we can get a qualified business income deduction with an S corporation? The thing about S corporation is you can only do an S corporation right here if your company is a national US company. You don't have any international investors or international owners. Owners are all in the US as permanent residents or citizens, and all investors are in the US as permanent residents or citizens. you can't have more than, I believe, 100 investors or so. I'd have to double check that, but I think it's 20 to 100 investors for 2020 or 2019. But the thing is, with C corporation, you can have like as many investors as you want, but you don't get the qualified business income deduction. C corporation would be good if you're having international investors and you're trying to get investments from all sorts of different sources, and you don't know how your company's going to grow at a large pace you expect. Now, why would you do a partnership? Partnerships are good too because you also get the qualified business income deduction. But partnerships are also good if, like, for example, you want to deduct your personal income or salary from the organization. You get to also do that with an S corporation. You get to deduct your salary, for example. Like I have a salary here of $80,000, and then you can also do that with a partnership too. But the thing about partnerships is you have to be bound to a partnership agreement. And then you also have self-employment tax. I didn't add that to my template, but it's basically a tax that is added to this entity level tax, which actually I made a line for. So you can put your self-employment tax over here. There's no entity level tax as there is for a C corporation, which is 21%. But with a partnership and S corporation, you don't have that. And with both of those, partnership and S corporation, you get a qualified business income deduction without an entity level tax. And with both S corporation and partnership, you get to deduct your personal salary if you pay yourself as an owner, which I'm putting here as $80,000. Now, why is it important to know all this? Basically, like these different entity types have different tax rates. So you might want to figure, like, are you going to have profits the first years or are you going to have losses the first few years? So let's say I have no profit the first year from my partnership. I don't owe any tax then. Let's say I have a lot, like some income the second year. So I have $750,000 of revenue, $500,000 of expenses, which includes my salary. Then I have taxable income of $250,000. So then I get qualified business income deduction of $50,000, which is 20%. And then taxable income becomes instead of $250,000, becomes $200,000. So with partnership, it looks like my combined tax rate is 29.6% for the second year, 0% for the first year. If I were to do a C corporation, if I did the same thing with a C corporation, let's see what would happen. So no income the first year. It's just you break even. Second year, I'm going from no income to a $250,000 gain. Now, here's the thing. I don't get a qualified business income deduction in my C corporation. You see, actually, I moved down too much. There's my C corporation. I don't get a qualified business income deduction for my C corporation. I get basically what's called an entity level tax of 21%, which adds a tax of $52,500. So my income after tax becomes $197,500. But not only that, I don't only just get no qualified business deduction. I also have to pay an individual tax because C corporations have what's called double taxation. So in addition to the entity level tax of $52,500, I also have to pay an individual tax of $47,005. So my total tax is actually more. I was like, with a partnership, my total tax is like $74,000, but with C corporation, it is about $100,000. If you look at this, the difference between this and this. So actually, my combined tax rate is, let me fix this right here. $39.8%. So like I said, my total tax is $99,505 the second year. With a partnership, it's only 74,000. But unfortunately, with a C corporation, my total tax is 99,505, which puts me at an effective tax rate of, let me move it back. Sorry, guys. I'm trying to get it to settle onto the C corporation. My tax rate, effective tax rate is 39.8%. How does it go from 29.6% to 39.8%? That's why you need to choose your tax entity carefully. If you can come to someone who knows about this and can advise you best, maybe we can give you the benefits and disadvantages of each type of entity so that you don't pay so much taxes that you don't have to. That's all I have to share today. Let me ask my CTO, what did you think of that, Miles?
Yeah, that was great. That was super informative. And guys, I mean, that should really hammer home why you need to use a tax consultant like Victoreus. That's another 10% on top of your 30% tax rate if you're choosing a C corp over an LLC. And obviously there's pros and cons to both, but that's not chump change. That's a huge chunk of change right there. So it would certainly behoove you to give us a call if you have any questions about how you might want to structure your business, because we can definitely help you out with that.
Yeah. Stay tuned for more coming soon. And if you'd like to visit us, it's www.victorious-co.com. And we look forward to serving you. Thank you very much, guys.